I'm Aditya Nain, and welcome to my podcast on money, investments, and finance with a focus on Canada and global topics of interest to Canadian investors. So, in this episode, we talk about the second coronavirus wave, its implications on commercial real estate, the possibility of investing in REITs, and some basic investment risk mitigation practices, to deal with turbulent markets and stuff like that. So, with the second wave of the pandemic having arrived, and the daily number of new cases has seen an exponential rise in the last 7 to 10 days. Official projections for the rest of the year from different parts of the world really are not encouraging. And so the odds on a quick retreat of the virus aren't too great. So naturally, investors are getting a little nervous. And while there's a sense in which we feel like we've seen this movie before, this fact itself has opened our eyes to the possibility of maybe living with this virus for longer than most of us had hoped or maybe even anticipated. So we were beginning to see a gradual reopening of businesses, and there was also serious talk of, the possibility of large sections of the workforce returning to their office spaces. However, I think far from seeing further reopening, we've begun to see the first signs not only of a stall to those reopening plans, but also an unfortunate and, no doubt painful rollback of the openings that had already taken place. So for instance, in bars, cafes, and restaurants, the immediate future isn't looking too bright at all. The Globe and Mail has reported that Montreal and Quebec City are now on the highest level alert with regard to COVID. And as a result, private indoor gatherings have been banned and bars, restaurants, and cinemas have been shut down for 28 days. More generally speaking, from a Canada-wide perspective, the Globe has also reported that the occupancy rate at Canadian hotels has dropped 53% from a year ago. This is for the week of September 13th to 19th. And the aviation sector, which is another indicator of the reopening of the economy, saw domestic flights at 21% lower compared to what they were just 4 weeks earlier. Points that aren't terribly encouraging for essentially physical businesses. As is clear from these numbers, 4 weeks can be a long time, and in the midst of a pandemic with sentiment changing constantly and quickly based on daily numbers, we can see things move either way in the near future. So with deteriorating news about the recovery making its way through various sectors of the economy, and with the possibility of further pain to businesses in the future clearly visible, the general effect on the state of commercial real estate is predictable, if not pretty. In another article, the Globe and Mail reported that Canada's largest cities with dense office spaces, as for example Toronto, Vancouver, Ottawa, and Montreal, have all seen spikes in their vacancy rates, with the countrywide commercial vacancy rate at 12% for the third quarter, up from 11% the previous quarter. In Calgary, it's even worse, in fact, and the downtown vacancy rate there has been reported to be 30%. That's a massive 30% because of the dual effects of the pandemic and the oil price shocks we've seen this year. So much like the hospitality and airline sectors, both of which saw some signs of life before a slip back to lesser traffic and increased chances of shutdowns, real estate in downtown Ottawa and Montreal too has backtracked, having given up some of the initial revival that we had seen. And office vacancy rates in these two cities have seen a recent spike as well. Montreal's, for instance, has increased from 7.3% to 8.7%, and Ottawa's is up from 7.7 to 8.8%. Now, these numbers accompanied by decisions to extend work from home practices till the end of the year, and in some cases indefinitely, will no doubt force both large and small commercial tenants to reevaluate their need for office space, maybe on a permanent basis. So in the same article just referred to, the Globe reports that technology companies, which is expected, such as Facebook and Shopify, have already made it known that most of the staff can work from home. And other tenants such as TD and KPMG have also extended work from home. TD, for instance, is reported to have asked their staff to work from home until Jan 2021, while KPMG has only 5% of its staff working from its offices. So, it seems clear that as long as the coronavirus risk remains, commercial real estate will be a bit shaky. So in an investment environment overshadowed by all the risks associated with the virus, we'll pick up two investment themes today. The first is real estate investment trusts, or REITs, and the second is just some simple investment risk mitigation practices. So although it may seem counterintuitive to consider investing in REITs at this time, especially given the picture that I just painted, there are three perspectives from which certain investors, not everyone, but certain investors may consider it. So first, there's the contrarian case of buying into an asset class that's been beaten down pretty hard and is therefore possibly undervalued. In other words, maybe some investors find certain categories of REITs undervalued right now because of the fact that they've seen massive drops in price since the start of the pandemic. The case for the contrarian view is strengthened by the fact that REIT prices have, to a large extent, continued to remain depressed despite a broad rally in the stock market. Second, REITs can be a tactical choice during this pandemic precisely because of the types of assets some of these REITs hold. So for instance, some REITs may benefit from being exposed to apartment properties as opposed to commercial properties, and others may benefit from the growth of companies tied to the essentials retail space. The essentials that we all need during the pandemic. One of the few sectors of the economy that has been disrupted less than others, or maybe even has benefited from the pandemic. So finally, in an investment environment starved of attractive income options, this is the third reason, because we have historically low bond yields, REITs have come into favor, and in fact, even high-yielding dividend stocks have, just to provide that extra income for income-seeking investors. For instance, retirees who are looking to generate income from their investments. Now, while REITs can't completely replace bonds, for various reasons, many investors will, with the need to generate this regular income from their investments, will no doubt be looking for alternatives to bonds and may be willing to take on some additional risk by reallocating, let's say, a partial portion of their bond holdings to REITs and also to dividend stocks. There are a number of strategic approaches that one can take towards investing in REITs, and I'm just going to talk about one. So the Globe and Mail columnist John Heinzel has recently written about this, and he approaches the problem specifically from the perspective of riding out a second wave of the pandemic. And his observations and analysis is based on what he saw happen in the first round of the shutdowns. So his approach in selecting REITs with the aim of mitigating second wave risk is based on three key criteria. The first is tenant stability, which is helped by a highly stable major tenant, one that preferably hasn't or didn't experience significant disruptions during the first wave or the first phase of shutdowns. His second criteria is the weighted average lease term, or the WALT, which is it's a measure of the length of the remaining lease terms of a REIT. So in this regard, Heinzel's approach is to select REITs whose WALT, or weighted average lease terms, is above the sector's average. So unlike in the case of bond funds, for example, in which the risk decreases with a decreasing average length of maturity of the bonds held, longer WALTs potentially mitigate REIT risk because of the relative certainty and predictability of future cash flows. As the third and final criteria, Heinzel wants to make sure that the fundamentals of the REIT justify any interest in them, right? So, and this is gauged by him through their balance sheets, their sustainability of the distributions, or the sustainability of their distributions, and also long-term growth potential from development projects. So based on these criteria, he identifies three REITs that investors may choose to consider. And each of his choices is anchored on a large retailer, all of which have so far weathered the coronavirus storm. So if you want to find out which these three REITs are that he identifies, and maybe a little bit more about them, head over to his article in the Globe and Mail. I've provided a link in the description. So apart from targeted opportunities in specific asset classes, such as REITs that we just discussed, the second wave is also making investors nervous about the strength, durability, and also just the quality of their portfolios, generally speaking. So this is especially true for first-time investors with little to no experience in navigating turbulent market conditions, let alone anything as unnerving as the implications of a pandemic. So in times like this, it's best to revisit some time-tested risk mitigation or risk management strategies, the kind of boring stuff that doesn't sell but saves you your hard-earned money. So towards this end, Rob Carrick recently published an opinion piece where he listed out three very simple and basic points, sort of investment 101 points, of how to cope with potential second wave stock market risks. So the first point that he brings up is, well, don't risk money you can't afford to lose, which means that you'd be well served to withdraw any money you have in the market that you can't afford to see disappear. So this also translates to not investing any fresh money that you may need in the short to medium term. So if there's any money that you may need within the short to medium term, then this money should not be in the market, especially if you're a first-time investor. The second point is, well, don't panic sell in the case of a drop. So if the markets do fall and they have dipped recently, then don't go panic selling. And this is because it's never a good idea, especially since most investors will not have the stomach to re-enter at the lows. And if you can't re-enter at the lows, then that messes with investor psychology. You end up taking further bad decisions because of that first panic sell that you did. The third point that he brings up is to be ready to buy the dips if the market falls. And this is because nobody really knows what the market bottom is before it's actually happened. This means that you've hopefully been buying at various price points over the last month as the markets have dipped. So in addition to his points, here's one of my own. Make sure your portfolio is well diversified and you don't have all your eggs in one or even two baskets, really. So that's it for today's episode. Please hit the like button if you found it useful. Also, don't forget to subscribe and hit the bell icon if you want to be notified of future episodes. Thanks a lot. That's it.